Welcome to Wealth Sense, where we're dedicated to helping you make smarter financial decisions at every stage of life. If you're in your 20s, you're in a pivotal time when it comes to your money. You're likely starting your career, paying off student loans, and facing new financial challenges. In this video, we'll discuss 5 common money mistakes that many people make in their 20s and show you how to avoid them. Whether you're looking to save more, build credit, or invest for the future, this video is packed with practical tips and expert advice to help you get on the right track. So, grab a pen and paper and get ready to take some notes. Let's dive in! Mistake number 1. Not having an emergency fund. It is one of the most common money mistakes people make in their 20s. Life is full of surprises, and you never know when an unexpected expense might come up, such as a sudden job loss, medical emergency, or car repair. Without an emergency fund, you may be forced to rely on credit cards, loans, or help from family and friends to cover these expenses, which can lead to debt and financial stress. To avoid this, it's important to have an emergency fund set aside for these situations. An emergency fund is a separate savings account that is earmarked specifically for unexpected expenses. Experts recommend having at least 3 to 6 months of living expenses saved up, depending on your circumstances. This means that if your monthly expenses are $3,000, you should aim to have between $9,000 and $18,000 saved in your emergency fund. Starting an emergency fund can be challenging, especially if you're already living paycheck to paycheck. However, the key is to start small and be consistent. Even setting aside a few dollars each week can add up over time. Look for ways to cut back on expenses, such as dining out less often or canceling subscription services you don't use. You can also consider starting a side hustle to earn extra income. Having an emergency fund gives you peace of mind and financial security. It allows you to handle unexpected expenses without going into debt or relying on others for help. So, start saving today and make it a priority to build up your emergency fund as soon as possible. Mistake number 2: overspending on credit cards. Overspending on credit cards is another common money mistake that people make in their 20s. While credit cards can be a great tool to build credit, they can also be dangerous if not used responsibly. Many credit cards offer tempting rewards programs and cashback incentives, which can make it easy to overspend and accumulate debt. To avoid this, it's important to only use credit cards for purchases that you can pay off in full at the end of the month. This means only charging what you can afford to pay off when your bill comes due. If you're unable to pay off your balance in full, you risk accumulating interest charges, which can quickly add up and make it harder to pay off your balance in the future. In addition to high interest rates, late fees can also add up quickly and damage your credit score. Late payments can stay on your credit report for up to 7 years, which can make it harder to get approved for loans, credit cards, or other financial products in the future. To avoid late payments, set up automatic payments or reminders to ensure that you pay your bill on time every month. It's important to remember that credit cards are not free money and should be used responsibly. While they can be a great tool for building credit and earning rewards, they can also be a slippery slope towards debt and financial stress. By using your credit card wisely and only charging what you can afford to pay off in full, you can avoid this money mistake and use your credit card to your advantage. Mistake number 3: not investing in yourself. Not investing in yourself is a that people make in their 20s. One of the best investments you can make is in yourself. Spending time and money on learning new skills, getting a degree, or starting a business can pay off in the long run by making you more valuable in the job market. Investing in yourself can take many forms. For example, you might consider going back to school to earn a degree or taking courses to learn a new skill or trade. You might also consider attending workshops or conferences to stay up to date with industry trends and best practices. Investing in yourself can also mean starting a business or pursuing a side hustle that allows you to build your skills and earn extra income. The more you invest in yourself, the more valuable you become in the job market. By acquiring new skills and knowledge, you become a more attractive candidate for employers and can command a higher salary. Investing in yourself can also give you a sense of purpose and fulfillment in your career, which can lead to greater job satisfaction and overall happiness. It's important to remember that investing in yourself doesn't necessarily mean spending a lot of money. There are many low-cost or even free resources available, such as online courses, webinars, and networking events. The key is to be proactive and seek out opportunities to learn and grow. In summary, not investing in yourself is a money mistake that can limit your earning potential and overall career success. By taking the time and making the effort to learn new skills, earn a degree, or start a business, you can become a more valuable asset in the job market and increase your earning potential. So, don't be afraid to invest in yourself and your future. Mistake number 4. Not tracking your spending. Not tracking your spending is a common money mistake that people make in their 20s. With the convenience of debit and credit cards, it's easy to lose track of where your money is going. This can lead to overspending, living paycheck to paycheck, and not having enough money to save or invest. To avoid this mistake, it's important to make a budget and track your spending. A budget is a plan that outlines your income and expenses for a certain period of time, usually monthly. By creating a budget, you can see where your money is going and identify areas where you can cut back. This can help you save money and reach your financial goals, such as paying off debt or saving for a down payment on a house. There are many budgeting apps and tools available to help make the process of tracking your spending easier. These apps can automatically categorize your expenses, alert you when you're overspending, and even suggest ways to save money. Some popular budgeting apps include Mint, Enab, You Need a Budget, and Personal Capital. Tracking your spending can also help you develop good financial habits, such as saving money and living within your means. By being aware of where your money is going, you can make more informed decisions about how to spend it. This can lead to a greater sense of financial security and peace of mind. In summary, not tracking your spending is a money mistake that can lead to overspending, living paycheck to paycheck, and not having enough money to save or invest. To avoid this mistake, make a budget and track your spending using an app or tool. This can help you save money, reach your financial goals, and develop good financial habits. Mistake number 5. Ignoring retirement savings. Ignoring retirement savings is another common money mistake that people make in their 20s. Retirement may seem like a long way off, but the earlier you start saving, the better. The power of compound interest means that even small contributions made over a long period of time can add up to a substantial nest egg by the time you're ready to retire. One of the easiest ways to start saving for retirement is to take advantage of employer 401k matching programs, if available. This means that your employer will match a percentage of your contributions to your 401k plan, up to a certain amount. This is essentially free money that you can use to boost your retirement savings. In addition to a 401k, you can also start contributing to an individual retirement account, IRA. There are 2 main types of IRAs, traditional and Roth. Both offer tax advantages, but in different ways. A traditional IRA allows you to deduct your contributions on your taxes, while a Roth IRA allows you to withdraw your contributions tax-free in retirement. Speak with a financial advisor to determine which type of IRA is best for you. Time is on your side when it comes to saving for retirement, so don't put it off. The earlier you start, the more time your money has to grow. Even small contributions made in your 20s can add up to a substantial amount by the time you retire. Plus, starting early can help you avoid the stress of having to play catch-up later in life. In summary, ignoring retirement savings is a money mistake that can have long-term consequences. Take advantage of 401k matching programs, start contributing to an IRA, and start as early as possible. Your future self will thank you for it. And there you have it. 5 common money mistakes to avoid in your 20s. By following these tips, you can set yourself up for financial success in the long run. If you enjoyed this video, please give it a thumbs up and subscribe to our channel for more financial advice. Thanks for watching.